July was a little bit of a bumpier month, a noisier month. I don't think necessarily because we're going into August that it means it's going to be smooth sailing from here for the rest of the year. That never happens in markets. So just don't be surprised if we see some noise, some turbulence, some bumps. But again, we've got the portfolio, the strategy. We've got good positioning for steering through that. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, it's Friday. We're back. I'm back in the seat here with Greg. Another interesting bit of a wild week of up and downs in markets. We have the long weekend, beautiful weather out there today, which is nice. But how you doing over there, Greg? What's going on? What's happening today?
Yeah, good to have you back here in the saddle, Will. And yeah, long weekend coming up. Hard to believe it's almost basically halfway through summer. We got the August long weekend, so hard to believe. But it's been nice weather, so no big complaints. But just heading up north, seeing some family, hoping to enjoy the nice weather. So should be fun. But what about you, Will? What are you up to?
Same story. We're heading up to the cottage tomorrow. We had. Last week we had lots of family stuff. We had a bit of a family reunion up north. All the kids and grandkids. Everybody was all in the same spot. So my mom had all her 10 grandkids in the same spot for the first time. So that's why maybe I don't look as relaxed or as refreshed as I should after a week away. But that's how it goes.
Yeah, that's how it goes. Wow, that sounds like it'd be a lot of fun, but maybe a lot of chaos at the same time.
Yeah, you know what? More kids, we find when there's big groups, they actually do quite well because they all play together and entertain each other. And when it's not all siblings, it was all the cousins. They all tend to get along pretty well, so it was pretty good. But yeah, still lots of work, lots going on, and. Back up there this weekend, but it'll be a little bit quieter for us this weekend. But looks like we're getting some nice weather. I know July has been pretty nice, other than the heat waves and wildfire smoke. July's been pretty nice, but market has been a little bit softer for sure through July. I think if we go back a month or so, as we were getting into summer. Our portfolio's markets were bumping up on all-time highs, and we've definitely seen some little bit of drawdown, a little bit of drag. So we want to talk about some of the drivers of that. What's going on? What's nice? Yesterday, you had a really strong recovery day across the market, across the board. Our portfolios as well. Pretty much everything was going up. Today, markets are kind of resetting, maybe a little bit softer. We had the Fed meeting on Wednesday, which I think really for us and for markets has been the story, is that there's still this inflation, there's this interest rate story. The Fed, the new Fed chairman, seems to be more hawkish as well, and markets are expecting or anticipating that we might be getting rate hikes, which has some implications on our portfolio, our position, our strategy. But anyways, looking forward to diving into things today, Greg.
Yeah, July has been a very, very busy month. You have the Fed, you have geopolitical stuff always continuing to go on. You had earnings as well. So now that we're at the end of the month, I guess what if you kind of summarize what happened in July, some of the drivers, what was going on underneath the hood?
I mean, you're starting to see a little bit of rotation, which you and Roman talked about last week. You're certainly starting to see a little bit of a rotation away from the growth trade. Some of those areas, like this month, semiconductors, chip names, the Nvidias of the world, for the most part, got hit pretty hard through July. So keep in mind that's after a massive run off the lows in March, a massive run over the last year or so, and losing some steam. Conductors were down 20-25% in that range, which certainly creates some challenge for areas like the NASDAQ, those growthier areas of the market. We've also seen, for our portfolios, we've certainly seen the pressure towards higher rates, U.S. dollar pushing up which is not necessarily a bad thing. It's put some overall pressure on gold equities, those areas which we've got a good amount of exposure to as well. So there's a few key drivers there. Overall, we have seen oil and energy prices moving up because of this renewed conflict. Some of the more recent positions that we added to the portfolio in the last month or two have gotten a bit of a boost from that, which is good because we've got some of that more value, more dividend positioning. But we are starting to see a little bit of that shift through July, which we've been talking about for a while. Some of it's certainly good for our portfolio. Some of it creating some drag on some key parts, but we're seeing some of these trends change a little bit here.
And to your point, Will, within the last couple weeks here in July, we've really seen that rotation continue. Like energy has picked up steam, gold's picked up a little bit of steam. So some of those trends and themes that we've been talking about that maybe have been under pressure at different times earlier in the year have kind of started to show some life and strength as we move into the back half of July.
Yeah, and those commodities areas, precious metals, they are starting to show some life. I wouldn't quite say that they're right there and back resuming the uptrend yet, but we're starting to see some signs of life on some of the weaker days that we've seen in July. Gold is acting as a countermeasure where it's actually going up. Some of the commodity funds where we've got more energy, agriculture exposure, those are going up on some of the down days. So commodities acting like a little bit of a hedge for us, which is good against some of those growthier areas of the market.
Yeah, and this past week was an example. On Wednesday, the Fed came out, they held rates, but it was a little bit more hawkish. Markets sold off on that news, but to your point, Will, you had energy moving higher, you had gold moving higher. So you're starting to see maybe not quite as correlated and seeing it be a little bit of a counter trend to some of the more tech and growth areas of the market.
Yeah, and you've seen some of the areas of the market that maybe have been a little bit more beat up this year. We're catching a bit of a bid and catching some steam. So some of the software stocks, as an example, or just some of these areas that maybe for a lot of 2026 have been out of favor. There's money rolling into it through July. So it's been interesting to see, but certainly a change overall. Oil's been spiking. Some of the names, like a name we have in our portfolio, Microsoft, had a very strong day and month overall. Energy's been moving along, and some of those more just beat up names in the market have started to show some signs of life. So just more a comment on what's going on out there, that we're starting to see some of those winds change, some of those trends change, and looking at things accordingly.
Yeah, no, absolutely. So just given all that, Will, I guess just in general, how are you thinking about markets just in general, given what we had talked about, given some of these trends, given some of the bigger picture macroeconomic stories as well? How are you thinking about things in general?
Look, there's still opportunity out there. I would say, given that we've had a bit of a softer month in July, there hasn't been a lot of those, and we've seen in this bull market run and this move up. Every time you get a little bit of softness, a little bit of weakness, it turns out to be a phenomenal opportunity, a great opportunity to be putting cash and putting money to work. So I would say now is as good a time as probably ever to be thinking about that. Overall, in terms of opportunities, deploying funds, there's a lot of these areas that have become washed out or have starting to show that they're oversold and perhaps presenting some opportunities. So I think that makes it interesting in terms of deploying cash, deploying capital here, putting funds to work. I mean, we're now in, keep in mind, the fourth year of a really strong market run since 2022, and I think that's the real risk is more one of this growth scare of inflation, of interest rates. Some of the stuff we're starting to see happen this month where you get a pretty meaningful correction at a NASDAQ and some of those growth and leadership areas of the market. If that trend were to continue, I think that's going to create a lot of challenges. If for inflation, interest rates, that end of the market run away like we saw in 2022, it would be a real growth scare, and I think that's more the risk. But I think we're certainly not early in the market cycle or anything along those lines, but I don't think it's necessarily the end of it. I think we're getting the later stages of a growth cycle here. There's risks we're watching out for, risks we're keeping an eye on, but still plenty of opportunity for new funds to be put to work. And if you're geared a little bit more, which on the margin, certainly we've work to do, be a little bit more geared towards value portfolio, a dividend portfolio, a little bit more closely correlated with the TSX, with commodities, some of those areas, you're going to fare a lot better in this environment. So I've said this kind of all year. I think if we're tied a little bit closer to the TSX as opposed to the NASDAQ overall, you'll look at a year like 2022, how markets performed, or go back to the 2000s. If you were heavily invested in the Nasdaq in the year 2000, that decade was not a great time to be invested there. If you were more tied to the TSX, to dividend, to value, you still went through the ups and downs of the market, but you came out okay on the other side of that 10 years later, where I think that's the kind of market we're starting to see, starting to transition towards more where you want to have real assets, hard assets, more value over growth. And that's why, even though some of our positions this year, gold as an example, those types of names were real stars last year, have gone through a bit of a lull this year. There's still longer term areas strategically that we want to hold and make a lot of sense in this market environment in the portfolio.
Yeah, so you mentioned Will. We've talked about the Fed here. Would you, in your estimation, going forward, is it really going to be the main drivers of the market? Is it really going to be the Fed, interest rates, inflation, and just kind of how that story develops over the rest of the year is how it's going to impact the market?
That's a big one. I mean, you've got the AI story is still very much driving things and driving growth, which underlies that. I mean, we also have, which is I'm sure going to create a little bit of uncertainty in some of the unknowns out there. We've got the midterm elections, which is going to create a lot of just uncertainty, angst in the markets, angst in investors. I think you might get some trades being placed and some movement towards other areas of the market that play off that trade if there's a shift in the balance of power. But there's politics, there's geopolitics still that are driving things. Yes, there's inflation, interest rates, what the Fed's going to do. AI is another big story. You're starting to see that some of the companies under the hood, when you're seeing these bigger companies like Apple and Google and Amazon and all of that report earnings, is that depending on whether they're beneficiaries or they're big spenders or how they're playing that AI theme, the market is either rewarding or punishing them in this environment. So we've seen some positives from, say, Microsoft and Apple for the most part the last little while, and those names are responding well. Amazon as well for the most part. So, anyways, the AI piece of it is still very much at play here, and I think as we look forward through the rest of the year, I don't think you can entirely discount or take away the politics and what we're going to see happen there, because there's likely going to be a lot of noise, a lot of uncertainty as we move into the fall here.
Yeah, and to your point, Will, Microsoft, I saw yesterday, it was up 15% or so. I think it had its best day ever, right? So that was good for our portfolio. We've had Microsoft's been a good core position for us for a long time. But I guess just in terms of big picture positioning, Will, with the portfolio and with the strategy, I know it can change quickly depending on market conditions. Are we more fully invested? Are we kind of more on target, maybe a little underweight? Where are we in that spectrum overall?
Yeah, I mean, we're probably a little bit underweight in terms of equities, a little bit more on the conservative side right now. But part of that is because we do have more commodities and natural resources investments that make up the alternative sleeve of the portfolio. So we're not sitting there fully invested in markets. We're certainly not 100% all in on equity markets. So little bit underweight at this point in terms of pure equities, but we've made that up with some of the commodity exposure, which has done its job, has performed as we have wanted to. Some of that sort of alternative type exposure through through this month, through July, when you've got the Nasdaq correcting 10% or something in that neighborhood, and those names we've had some of those sort of non-market, non-correlated types of assets bucking the trend and pushing things up. So right now, a little bit more conservative. We certainly haven't had all the high growth areas and high growth pockets of the market, which to me in this environment, given where we are a little bit later in the cycle after several really good years of market returns, that's okay. But we're doing all right. We're moving in the right direction here overall.
Yeah, no, absolutely. So this week, Will, is a very, very busy week. Earnings, inflation, the Fed coming out. As we move into next week and maybe just through the rest of the summer, is there anything in particular investors should be mindful of or watching for as we move into the next few weeks here?
Look, we're coming through the end of summer into the fall. I do think just keeping an eye on this. Any noise that's coming from the Fed, from the inflation story, from the interest rate story is certainly the big one. I think. Look, August, September, October can definitely be bumpy months, but we've got the portfolio, the positioning, the process for steering through that and navigating through that. So, I mean, don't be surprised. July was a little bit of a bumpier month, a noisier month. I don't think necessarily because we're going into August that it means it's going to be smooth sailing from here for the rest of the year. That never happens in markets. So just don't be surprised if we see some noise, some turbulence, some bumps. But again, we've got the portfolio, the strategy. We've got good positioning for steering through that. Part of the reason we've got that commodities and natural resources positioning in the portfolio as well. And we've got really the right strategy for navigating through all of that.
And that's the most important thing, I think, is just the process and the strategy. And to your point, Will, we're probably going into a continued period of volatility, but with our process right now, we do have cash as part of our strategy that when the time is right, we'll be looking to deploy. So I think that's important as we move through the next maybe 3 months or so to keep in mind.
Yeah. And I mean, the growthier areas of the market, we've certainly seen them lose steam, but I do certainly think there's still good potential, good opportunity when you look at those more value, those more dividend, those more let's just say Canadian TSX type of positions, not necessarily exclusive to that, but those types of sectors and names. So overall, we're having a good year. I know July a little bit of a bumpier month, which is not fun to go through, but at the end of the day, we want you to be wealthy. We want you to enjoy life. Enjoy the summer, enjoy the nice weather, enjoy retirement. We want you to feel wealthy. We want you to realize your wealth. That's what Aretec Wealth is all about. That's what we're all about. And we'll be back with everybody next week. Thanks.
Have a good one.